Welcome to this explainer. Today, we're diving straight into a fascinating breakdown of the entirely legal strategies the wealthy use to minimize their IRS bills. Our goal here is to demystify the tax code. We're going to trace a journey right up what we'll call the wealth ladder, moving from everyday household tactics you could probably use tomorrow, all the way up to absolute billionaire master moves.
Here is our roadmap for the climb today. We'll start with everyday wealth building tricks, move into small business tax secrets, uncover real estate empire loopholes, examine generational wealth master moves, and finally, we'll wrap up by discussing the true value of wealth. Let's get into it.
All right, part one, everyday wealth building tricks.
Let's kick things off with a super powerful strategy that almost anyone with a down payment can use. It's called the Section 121 exclusion. Basically, if you're married, you can exclude up to $500,000 of capital gains, which is simply the profit you make from selling an asset, when you sell your house. The only real catch? You just have to have lived in it for 2 of the past 5 years. Our source gives this great example. A couple bought a fixer-upper for $400,000, lived in it while doing the renovations, and sold it 2 years later for $850,000. That $450,000 profit was entirely tax-free. They actually repeated the cycle 4 times, generating over $2 million in wealth without paying a single dime to the IRS.
Moving right along to part 2, small business tax secrets. Once you own a business, the rules of the game completely change. Have you ever thought about making your kids your best tax deduction? Seriously. Under Section 162, you can legally hire your own children. Now, the work has to be real. Think managing social media, cleaning the office, and the wage has to be reasonable. But here's where it gets cool. Because of the standard deduction, your child pays 0 federal income tax on earnings up to $14,600 a year. But the absolute masterclass here, if you fund a custodial Roth IRA for them with roughly $7,000 a year from age 7 to 18, that account can compound to $2.3 million by the time they retire. And yep, it's completely tax-free. Now, what happens when a high earner hits an income limit? Take the 1998 pass-through deduction. It gives business owners a flat 20% tax deduction on their profits, but high-earning professionals, like successful dentists, phase out of this if they make too much money. So how do they keep that sweet deduction? They legally slice the practice into distinct entities. The core dental practice might exceed the limits, but notice what they do. They create an equipment company, a real estate company, and a management company. The main practice pays fees to those 3 entities, and those 3 do qualify for the 20% deduction. It's the exact same revenue, just brilliantly restructured. All right, climbing higher to part 3, real estate empire loopholes. This is where high-income W-2 earners literally wipe out their tax bills. Think about a normal landlord. They take the value of a property and slowly depreciate it over 27.5 years. Boring, right? The wealthy do something else entirely. They combine short-term rentals with a tactic called cost segregation. Basically, they hire a specialist to legally classify parts of the house, like the carpets, the appliances, the fixtures, as aging faster. This lets you accelerate the depreciation, meaning you can write off 20 to 30% of the entire purchase price in year 1. Imagine a software engineer making $450,000 who buys a vacation rental. They can create such massive paper losses from this that it actually cancels out the taxes from their day job. It's wild. But what happens when you actually want to sell that real estate? Enter the legendary 1031 exchange. It's famously known as the swap till you drop strategy. This rule allows you to sell a property and roll the profits into a new, larger property without paying a single dime in capital gains tax. So you buy a duplex in your 30s, trade up to an apartment complex in your 40s, and a massive commercial building in your 50s. You defer taxes your entire life, and the ultimate loophole happens at the very end. When you pass away, your kids inherit that massive portfolio at what's called a stepped-up basis. The IRS just resets the property value to what it's worth on the day you die, completely wiping out decades of historical taxes. Okay, we are now reaching the top tiers of the ladder. Part 4, generational wealth master moves. We're talking tech founder and billionaire territory now. Let's talk massive startup exits. Normally, cashing out of a successful startup means giving millions to the IRS. But Section 1202 of the tax code allows early employees of qualified businesses to skip federal capital gains on up to $10 million in profit. But wait, the ultra-wealthy actually take this a step further through a concept called stacking. A founder getting ready to exit a $100 million company might split their stock across 5 separate trusts before the sale happens. Because each trust claims its own $10 million exclusion, they legally shield $50 million from taxes. So what about publicly traded stock that has just exploded in value? The normal everyday approach would be to sell it, pay roughly 20% in capital gains taxes, and then maybe keep the rest or give some to charity. The wealthy approach? Donor-advised funds, or DAFs. Instead of selling, you donate the actual highly appreciated shares directly to the fund. Three amazing things happen all at once here. First, you get an immediate tax deduction for the full market value of the stock. Second, because you never actually sold the shares, you pay exactly zero capital gains tax. And third, you get to act as an advisor, directing those funds out to charities at your own pace over the course of decades, all while the money continues to grow tax-free.
I want you to really think about this staggering number, $5 billion. How far can tax-free compounding actually go? Well, back in 1999, Peter Thiel used just $1,700 in a completely standard Roth IRA to buy fractions of a penny shares in his brand new startup, PayPal. Because Roth IRAs grow entirely tax-free and any withdrawals you make in retirement are also tax-free, that single $1,700 investment, which he later rolled into other early tech investments, ballooned into a completely untaxed $5 billion fortune. It is literally the absolute pinnacle of retirement account utilization. Now for what our source calls the ultimate master move, the charitable remainder trust combo. Imagine you're selling a $10 million business. Instead of losing millions straight to the IRS, you transfer the business into a charitable remainder trust first. The trust then sells the business tax-free, reinvests the full $10 million, and by law is required to pay you an annual income of 5 to 8% for the rest of your life. That's up to $800,000 a year. And to make sure your kids don't lose out on their inheritance when you pass away, you use just a small fraction of that yearly income to buy a $10 million life insurance policy placed in a trust for them. You avoid the massive tax hit, you secure a lifetime income stream, and your heirs still get their $10 million.
And speaking of life insurance, for the ultra-wealthy, it really isn't about the death benefit. It's essentially a private tax-free bank. With private placement life insurance, you place millions of dollars into a policy that then invests in hedge funds or private equity. Because it's wrapped in a life insurance policy, all that high-yield growth is tax-deferred. When billionaires actually want to spend that money, they don't withdraw it and trigger a tax event. No way. They simply take out a loan against their own policy at incredibly low interest rates, usually around 1%. Since the IRS doesn't tax debt, they fund lavish lifestyles completely tax-free, and eventually, the policy pays out to their heirs, which easily covers the loans. Finally, Part 5, the true value of wealth. Let's take a step back from all these extreme loopholes for a second and look at the underlying mechanics. Look at the stark differences in effective tax rates as you climb. An everyday employee making $60,000 pays their taxes first, right out of their paycheck, and then has to buy their car, phone, and food with whatever post-tax money is left over. But as you move up the tiers, that entire strategy flips upside down. The wealthy run their lives through business entities. Cars, travel, and wealth managers are paid for before the tax is calculated. They're treated as business deductions. By the time you reach the billionaire tier, foundations and dynasty trusts basically own and deploy everything, driving their effective tax rate down into the single digits. But after exploring all this wild optimization, our source ends on a very grounding, almost contrarian note. They share a story about a mentor who happily pays a 50% tax rate to live in California. And you might wonder, why on earth would he do that? Well, because that's where his friends are, that's where his kids go to college, and that's where he's built deep community roots. Uprooting his family and moving to a zero income tax state just to save a few $1,000,000 on a spreadsheet would make him miserable. As the saying goes, downgrading your quality of life just to pay less tax is a bad trade. Which leaves us with this absolutely crucial final thought. Yes, the wealthy use the rules to legally shield assets and compound fortunes across generations. The strategies are real, and they are incredibly powerful. But optimizing for taxes should never, ever override optimizing for your own happiness. If utilizing these extreme strategies forces you into a lifestyle or a location you don't genuinely enjoy, then what is the true purpose of all that money? Learn the rules. Definitely understand how the system works. But always ask yourself, are you building wealth to serve your taxes, or are you building wealth to serve your life?